Welcome to the Topic 7 workshop, and today we'll be doing some intrinsic valuation. So in front of you, you see the worksheet that's available on iLearn, and what you see is the structure is somewhat similar to the forecasting sheet, but not really. So what you can see here is at the top, we have a discounted cash flow model. So that's the first model we'll be estimating today. We then have a residual income model just below it. And the way that these models work is they effectively look at some form of a future return and then discount it back to the present period. In the discounted cash flow models, we obviously focus on cash flows, whereas in the residual income model, we focus on residual income. So to get this started is basically what we're going to be having as a setup is we have a set number of assumptions, and we're going to be using these assumptions to effectively more or less discount our free cash flows that we forecasted back to the present period. We're then going to sum these up and also estimate the terminal value, and the terminal value is essentially the value of the perpetuity, because again, while we've only forecasted 5 years specifically, the firm is going to continue on forever. So we need to estimate the value of that perpetuity stream. And based on that, we're going to get to the enterprise value. The enterprise value, we're then going to be converting to the equity value, and I'll explain in the lecture exactly what the differences are and so on. And based on that, we can figure out what the share price is. So to get started, what we're going to start with is figuring out some of the assumptions. So the assumptions that we need for the discounted cash flow models is the WACC, the perpetual growth, and the forecasted years. Now the WACC, I'm just going to be grabbing from my WACC that I guess calculated last week, so it's 7.49%. I then want to look at my perpetual growth. Now the perpetual growth you can generally assume is going to be somewhere around CPI, so basically around inflation. And basically not much more. So in my case, I might look up what the official rate is for my country, but in this case, I'm just going to assume 2% for now. The forecasted years is basically how many years are we forecasting specifically, and that is exactly 5 years. I'm just going to type that in. And we now have all the assumptions that we need. Now, to get started, we need to effectively figure out what are the cash flows to the firm. And what we do when we figure out a discounted cash flow model is we start with the net profits and then get back to cash. Now, if you remember from the forecasting week, we've actually done this exact forecasting exercise previously. So if I get to the, net profit in 2017, I can just reference it from the forecasting sheet. At the very bottom, there's a section on the cash flow statement, and you can see that in 2017 in cell I-52, it's the net profit, and then we have all the adjustment and subtractions to essentially get it back to unlevered free cash flows. So again, that kind of references that net profit. If I drag it down, I also reference all the other additions and subtractions to get them to unlevered free cash flows. Now, once I have the first year referenced, what I can do is I can either drag it to the right, or if you want to take an alternative approach, you can copy it and then paste formulas as well, just a slightly different approach. The second part is now that we've estimated what the unlevered cash flows are in the 2017, 2018, and so on, we need to bring it back to the present value, because these are in future dollars. We want to understand what are they worth today. So to do this, we essentially need to discount them back to the present period. And for this exercise, we need to figure out what is the period in the future that we're essentially discounting. So in this case, we're going to use something that's called mid-year discounting. And again, this is something that will be explained a bit more in the lecture. But the idea here is that you're not discounting, something that is 1 year into the future. You don't discount it by 1. You discount it by 0.5, and the idea here is because cash flows would have been accumulated throughout the year, so we discount them by 0.5 to account for the fact that we've accumulated them throughout the year and they didn't just magically appear at the end of the year. Now, the second part that we need to do then is to figure out what the discount factor is. And the discount factor is essentially a multiplier for our unlevered free cash flows. You can see it as a percentage term or essentially a discount factor. So to estimate it, what you need to do is you need to type in equal 1 divided by, open up a bracket, 1 plus the WACC, and you want to lock the WACC because we want to drag it to the right, close the bracket and take it to the power of the discount period, so 0.5 in this case. Press enter and it should say 0.96. So again, I'm just going to copy that cell and then paste it to the right. And then to get the present value of the free cash flows for each period, all I need to do is take my unlevered free cash flows and multiply them by the discount factor. So for the first one, it's going to be 12,413. Again, you can copy it, paste it, or drag it to the right, whatever you prefer. And you're effectively calculated all the present values of the cash flows for the period 2017 to 2021. Now, to calculate the enterprise value of the company, so essentially the firm value, we can sum up these 5 present values of free cash flows for the first 5 years, but we then also need to consider what happens in the future. So the first step is to just sum up the first 5 present values that we've already calculated. That's step 1. We then want to figure out what's going to happen here in the future. And again, if you remember from your fundamentals of finance class or some kind of introductory finance class, the way that a terminal value formula works is that you look at the value 1 year ahead. So essentially what you want to understand is what is the free cash flows in 2022. So in order to do that, I need to take the 2021 free cash flows and multiply them by 1 plus the perpetual growth rate. If you do that, press enter, it should be 20,216. Now, to get to the terminal value of this amount, we essentially need to assume that this is going to become a perpetuity. And the perpetuity formula, again, you would have done this in your fundamentals of finance class, is equal to the terminal year free cash flow, and you divide it by, open up a bracket, the WACC minus the perpetual growth. Close the bracket, and that is the value of your perpetuity. However, this perpetuity is effectively now valued in 2021 dollars, so we need to bring it back to the present period. So what we need to do then is to estimate what the discount factor is, and the way that we do it is, again, it's similar to how we estimated the discount factors previously. We take an equal sign, say 1, and then you want to divide it by, open up a bracket, 1 plus the WACC, close the bracket, and take it to the power of, in this case, we're going to use the forecasted years assumption that we have up here. Press enter, and it should be 0.7. So the present value of the terminal value is thus the terminal value in 2021 dollars multiplied by the discount factor. So it's 256,542. The enterprise value then becomes the cumulative present value of the free cash flows, so essentially the first 5 years that we've already estimated, plus the value of the perpetuity. So add those two, and it should be 323,889 in this case. So the next step is to calculate the enterprise value, which we've technically already done, but to then get it back to the equity value, because the equity value is what we need in order to figure out what the share price should be based on our valuation. So the first thing that we start with is we figure out what is our enterprise value, and we just calculated it in cell C28. We then need to figure out what our total debt is and what our cash and cash equivalents are. So our total debt we can grab from the data sheet. So in the data sheet, in the total liability section, we can see that there is a row for short-term debt in cell H118, and the long-term debt is in cell H126. So you add those two up, and that gives you your total debt. Now, the cash and cash equivalents you also grab from the data sheet. So again, I go to the data sheet, but I go to my current assets section, and I can see that my cash and cash equivalents are in cell H85. Press enter and reference those. Now, the equity value is merely the enterprise value minus total debt plus cash and cash equivalents. Now for H&M, it's not a huge difference, but for some companies which have a lot of debt or a lot of cash, there will be a significant difference between equity value and enterprise value. Now to figure out the share price, what we need to first figure out is how many shares do we have outstanding. And again, this is something we get from the data sheet. So if you go to the data sheet, go down to the bottom, you can see that there is shares outstanding in cell H151. Press enter. So what we can do then is we can take our equity value and divide it by the number of shares outstanding, and we get a share price of $1.99. Again, this is the discounted cash flow model, and it's one of the most popular intrinsic valuations models out there. So the second model we'll be looking at today is the residual income model. Now, the residual income model works similarly in the sense that you're discounting something, a return that we're getting in the future, but instead of discounting cash flows, we are discounting residual income, which is effectively the economic profit. So again, similar to the structure of the discounted cash flow model, we need a set number of assumptions. So the first one that we need is the cost of equity. The reason why we're using the cost of equity and not the WACC is because we're only valuing the equity portion of the business. So this we can also grab from our cost of capital sheet. So if I go to the cost of capital, I see that my cost of equity is in cell D17, so I'm just going to reference that. The perpetual growth, again, we're going to assume that to be 2% currently, and the forecasted years is again 5, similar to the discounted cash flow model. Now, when it comes to the residual income, we're effectively trying to figure out what the economic profit is for each period. So in order to do this, we need to effectively compare the actual profit to the expected profit by the equity holders. So we start by figuring out what is the net profit in each of these periods. And again, we can effectively grab the net profit from 2017. So in cell I41 in your forecasting sheet, your beginning book value will be able to tell you what is the expected profit or the required net profit by the shareholders. So the beginning book value for 2017, you can also grab from the forecasting sheet, but you have to remember that assets, or basically anything on the balance sheet, is always captured at the end of the period. So in order to figure out what the beginning value is, you effectively need to take the ending equity in 2016. So this will give you the beginning book value for 2017, so H46. Now, your required net profit is merely equal to your beginning book value multiplied by the cost of equity. And again, remember to lock that cell because we're going to be dragging it to the right. So effectively, shareholders expected about slightly less than 5,000, and they got about 21,000, which means that the residual income is the difference between these two amounts. So the residual income in this case is 13,602. Now, the next step is to then also discount them back to the present period. But before we do that, I'm just going to copy that over to the right. So I guess, again, I'm just going to paste the formulas so that we get the rest of the rows populated and the rest of the columns populated. And now we can effectively do a similar process that we did for the discounted cash flow model, in the sense that we have to discount each one of these required net profits, or sorry, the residual incomes, into the present period. So again, we set the discount period as 0.5, 1.5, and so on, using mid-year discounting. And we then calculate the discount factor. And again, the discount factor is going to be equal to 1 divided by, and then you take, open up a bracket, 1 plus the cost of equity in this case, and you lock that cell, close the bracket, and take it to the power of the discount period in the cell, in this case, cell C51. Close the bracket, and the discount factor should be 0.96. So the present value of the residual income that we calculated for 2017 is worth 96% of the value in today's dollars, essentially. So we get it to 15,704 in this case. So that's kind of where we start, and what we can do now is we can essentially copy these over to the right. So paste the formulas to calculate the present value of the residual income for the first 5 years, and then we go through a similar exercise that we did for the discounted cash flow model. So the first thing we need to do is we need to sum up the present values that we've specifically calculated. That's step 1. We then need to figure out what is the terminal residual income, and that is merely going to be equal to the final period residual income, and we're going to multiply it by, open up a bracket, 1 plus the perpetual growth, close the bracket. Now, the terminal value of the, the residual income is again going to be using a perpetuity formula here, in the sense that we're going to take the terminal residual income, and we're going to divide it by, open up a bracket, the cost of equity minus the perpetual growth, close the bracket. And that is the terminal value of the perpetuity, but in this case in 2021 dollars. So we need to again figure out how do we discount them back to the present period. So we need to estimate the discount factor. So the discount factor, again, similar to how we've done it a couple times now, take 1, you divide it by, open up a bracket, 1 plus the cost of equity in this case, close the bracket, take it to the power of the number of years we forecasted, which is 5, and you get 0.69. So the present value of the terminal value will be equal to the terminal value multiplied by the discount factor. Press enter and you get about 292,000. So the total discounted residual income is going to be equal to the stream that we forecasted specifically plus the terminal value itself. So essentially the present values are the ones that we forecast specifically, and the terminal value in present value dollars that we've estimated in cell C60. And that's about 375,000. Now, when it comes to the residual income model, there's a slight difference in the sense that we are, one, looking at the equity value specifically, but after we considered how much economic profit or residual income we've made in the future, we also need to add beginning book value. So the beginning book value you can simply grab from cell C48 in this case, which means that the present value of the equity is going to be equal to the total future residual income in today's dollars plus the beginning book value. So it's going to be about 436,000. And again, similarly, we need to take this back to a per share value. We can get the shares outstanding technically from slightly above because we already referenced it in cell C36. So we can grab it from that cell, which means that the estimated value per share is going to be the present value of the equity divided by the numbers of shares outstanding. So about 264 Swedish kroners in this case. Again, in the workshop, once you're done, we're going to be also testing for sensitivity, but for now, you're basically done. Remember to answer the questions here at the bottom before you upload. And again, once you're done, just upload everything to iLearn.